It's time for us to look at humanity and go, is this really what we want? Is this about giving value or is it about taking value? And that's why I don't invest in the stock market. I know I'm pretty harsh on this whole thing, but we look at volatility, we look at compounded cost, we look at all of these factors. And to me, the solution is invest in yourself. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Crisis. Oh my God, how many times have you heard it? We're with the pandemic and the markets are going crazy. So everybody's worried, they're concerned, and so we're not here to be alarmists. We're here to say what really happened as far as day-to-day in the market with that volatility. How does that impact you? And after we identify the problem, what are some of the solutions? So, Chief of Staff Stova, a little bit fired up about this.
I am very fired up.
You watch the news, and now you're all huffy and puffy. Is that the right way to say it?
Huffy and puffy?
Yeah.
Like huff maybe and puff, a little bit for a little while.
I don't know.
And you saw
I think the last
that...
time I said that I was a kid, but that's why I asked if that's actually a term.
Yeah, I rarely watch the news, but on this instance that I did less than a week ago, they were just conveying how the stock market was going down because of this alleged, public health crisis and everything that's going on around that. And at that moment, I didn't really think and consider how that would impact and cause people to lose their money that have invested in 401ks and in the stock market. So then that got me thinking about all of the people that I know who have 401ks, and they're hardworking people trying to do the right thing. And I just thought in a matter of 15 days, they just lost a ton of money.
On paper.
Yeah. And so I think when we were having our team training,
I was training the coaches, and you got a little fired up there too.
I did get fired up, and I think this really matters. So I am excited that Tim's with us today.
We brought a money nerd, Tim Carden.
He's going to break it down for us.
If you ever watch, Money Matters, he's a frequent guest, and so Tim runs the numbers. He gets us the details.
Yeah, no, it's good to be here. And what we kind of talked about was like what happens to somebody who has like $50,000 they put in their 401k or their IRA. And what happened to them over the last 15 days in the market, right? And at first, we started losing money, but just a little bit. It was like there was a little bit of nervousness as a lot of the coronavirus hype was coming out. And so it created all this hysteria. Then we saw, manufacturing get shut down in China, made people a little bit more nervous because a lot of things are manufactured in China. And so we saw over those 15 days that if you just went by what the market lost on average without fees, they would have ended up with $44,593. And so for a lot of people, $50,000 in their 401k, that represents probably
$539.
Yeah,
okay.
Sorry.
That's $950. Wow. Let me show you how this works. I know that this is a big double click or single click.
$593.
There you go.
Thank you.
And so
$593.
That's what they would have ended up with. Now, in actuality, the part that I think is even worse for most people is the part that they don't realize. If they're just kind of tracking what the market told them it did, then and not calculating their fees and their losses as far as the to the actual losses, what they ended up with in that 15 days instead was $44,328. Okay. And that doesn't seem like a lot, but if you think about it, the fees over 15 days shouldn't have really amounted to more than $20 to $25. But instead, the fees and the actual loss numbers impacted them by an extra $260, right? And so that's kind of what happens to them. And for somebody that's got $50,000 in their 401k, how many years did you put money into that 401k to get to $50,000?
Yeah, we just had a question where someone was 67 years old and had $50,000 in the IRA.
Yeah.
So I don't know. Must have been a while.
Been a while, right? So losing $6,000 in 15 days, how many years is it going to take you to get back to just even? And when we see what the market did with this idea on the coronavirus, because a lot of the reports coming out now that I'm seeing by different doctors that are speaking out, Dr. Drew and others are saying, this thing is less deadly than the influenza. It's killed, less people. This is all just hysteria. This is a lot of hype. If you have a compromised immune system, be worried about it. If you don't, you're going to be okay.
I did cancel my Asia trip.
Yeah.
But because I don't want to get quarantined, not because I'm worried about dying from corona.
Exactly.
You know what I'm saying? I was like, I don't end up quarantined and being like, well, I guess I won't make this next event I'm supposed to speak at. I guess we can't film. No videos come out on YouTube unless I'm going to do it from some, who knows, makeshift hospital in South Korea.
Exactly. And so if you had your $50,000 in your 401k, you watch it lose $6,000, how productive are you right now?
I'd be stressed out if I had one of these things.
Exactly. And you're coming into an election year. What does that do to the market? Who knows?
Yeah.
Right. And so you go into the market, this kind of thing can happen to you. It can erode all the money you think you have on paper and just take it so quickly just because of hysteria, just because of hype. Let's find a safer place to put it where we can actually be productive, not be stressed out, and not have to worry about that kind of a 15-day.
Yeah. So break this down. How in the world did it end up at 44,326 versus 44,593? And what was the loss percentage over that 15 days?
Okay, so they averaged so they had an 11.4% loss. Like if you kind of go through and say they lost and then they gained, then they lost and they gained, it came out to 11.41 over that 15 days. Divide that by the 15 days, they averaged a negative 0.76% per day. That would have been your average, right?
Yep.
And so that's the number where you ended up with that 593 is if you just take that 0.76 for the 15 days, you ended up with the 44,593. But then I went in and said, okay, well, that doesn't calculate the fact that you paid a fee, right, each time anything happened. And you also had to still calculate like what really happened every single day. There was one day where we went down by 0.39 in the Dow. The Dow the next day went back up by 0.40. It started at 29,398, went down by the 0.39, went up by the 0.40. So you'd think it would have got back to 29,398. It got back to 29,348. So how does that make sense, right? That you'd go down by 0.39, go back up by 0.41, and end up with $50 less value in the Dow. It's because the losses impact you worse than the gains.
Right. So I like to, in easy numbers, if you have $1,000, you lose 10%, right? You're down to $900. Now, what if you gain 10% on $900? You don't get back to $1,000.
No.
You're at $990. This is what we're seeing here is that volatility impacts overall return. That actual returns in the market versus average returns are different things because there's fees in actual returns, because there's volatility where you have a loss but coming back up, you have less money earning that interest rate. And so this is part of the discrepancy of $44,593 after 50 grand in 15 days, and actual being $44,328 because they don't discount their fees or eliminate fees in down days. That's part of the problem.
Yep. And they were averaging about $1.30 a day in fees during this time, right? So over 15 days,
which seems inconsequential on 50 grand.
Yeah.
Yeah.
It does. It doesn't seem like a lot, but every time you pay the fee can't earn the bounce back either, right? It makes the losses more impactful. And then the bounce back is going to be on less money each time, right? So that's what happened. And so it seems like it's not a lot, but just in 13 days, there was a difference of $260.
15 days.
In 15 days, yeah. Sorry. $260 that you have less on top of the other loss you already took. And so you're just constantly climbing an uphill battle every time there's a loss. So that was the difference between the actual versus average and those fees was that $264. So when I went in and said, okay, instead of saying 0.76 per day, I was saying, okay, well, the first day we lost 0.43, then we lost 0.09. But then a few days later, we started losing like 3.56. And then we lost pretty substantially for a while. Then we bounced back by 5.09. We had one of the biggest single days of growth in the market ever 2 days ago or 3 days ago. And yet
from the time we're filming this, yep.
Yeah, then we still turned around, lost again, then gained again, then lost again, right? So it just is a lot of volatility, and I don't think that most of us want to be under that level of stress.
So if I were to say this in layman's terms, if you have ups and downs, it will impact your overall return.
Yes.
Even if it were even at the 0% over the 15 days, it's still going to impact the bottom line.
Absolutely.
So volatility has impact.
Yep.
So if you can create stability where it does nothing but go up, even if it was a lower average rate of return, it might actually be a higher net return. And this is a bit of a mess with your mind, but I think it's important to understand. How you feeling about it, Stolba?
I just feel so riled up about this. I just think when I hear these numbers and I hear you talk and you break it down, if you had this money in an account that you had access to that was liquid or it was cash in your hands and you just lost $50, you would know it, you would acknowledge it, and you'd be like, that was a few days worth of groceries. But because it's so far removed from people, they're not thinking about it. And then just over time, they're probably thinking it'll just all balance out at some point. But the way that you've painted the picture is it is not easy to recover from something like this.
Yeah, losses are compounded losses in the
Yeah.
market.
Losses are compounded losses. Now, I almost feel like this is why Vegas uses chips.
Mm-hmm.
You know, because it's not, you don't feel the cash. So in this, it's just dots on a piece of paper. It's just arrows on a news program. It's not the spendable cash that we have that day.
Yeah.
You know, if every day to day, it changed the amount that was available to order stuff or buy stuff, we would feel it so much more deeply. And these fees come out automatically. We're not writing a check. We're not, you know, touching a button to send the money over. Like it just happens.
Mm-hmm.
Yeah. And the people, you know, people don't worry about 30 years from now too much.
Yeah, that's
right?
what happens when we disconnect ourselves from our money is it's just somewhere down there it's going to be okay instead of realizing this has huge impacts on my life and the quality of life that I think I'm going to be able to live 10, 15, 30 years down the road, depending on how, you know, old you are when you start investing in these things. I think there are a lot of people graduating college where their companies are just automatically, it's you have to opt out of your 401k instead of opting in. And so common. This isn't something that impacts people that are just close to retirement, but people who are starting out too. Yeah.
Look, this is the crazy thing about it. Why did 401ks even come about? Because we used to have defined benefit pensions, right? People went to work for a corporation. The corporation said, you work here for this amount of time and you're going to get a retirement. Mm-hmm. And so they would say, this is the benefit you're going to get if you work here this long. Well, that put the onerous on these major corporations, which had, with those big dollar amounts in pensions, some of the brightest minds on Wall Street helping manage it. And they failed spectacularly. These pensions destroyed companies, declared bankruptcy. People didn't get what they expected. And what do? They put the onerous now on an individual that doesn't have access to those minds, that has a salesperson that they can typically meet with to say why they should fund this or where to allocate it with marketing terms associated with the funds overall. And so we've moved it even further away from the people that are in the know with the major knowledge. And how do we think this is going to work out? It's working out horribly. Mm-hmm. There's so many people with retirement plans that are not going to be able to retire, that are not able to get the cash flow that they wanted. And they feel a false sense of confidence along the way until when it gets really close to the end, they go, oh, wait, this didn't do well. So you don't have time value of money on your side anymore. So even if you add more money, there's not enough time for that money to grow. So, I mean, I think this is a major issue that people are not giving it the level of attention that it really deserves.
I'm with you on that.
And it got way worse because, like you mentioned, the pensions have failed miserably, right? But the companies were obligated to fund those pensions. So when they started to have underperforming, the companies would put more cash into those. That's not happening in the 401k system. So that's another big loss that we have. So the pensions funded, even with those funding requirements on the companies, how did we expect the 401k to perform better?
Right. Okay. So we see volatility kills.
Yes.
Compound losses, right? That these losses have a compounded effect. So what are the solutions?
Yes, let's get to the
Here's
solutions.
the solutions. Number one, you've got to build a peace of mind fund. You've got to have enough liquidity to have staying power when there's financial turmoil, when there's a quasi-pandemic, when there's a, negative news, so that you've got cash to handle, those short-term things. Second, pay off high interest rate loans. That's a guaranteed return. Why would you fund a retirement plan and have double-digit credit card interest rates? How often are you seeing that?
All the time. I see
all
that
the time,
very often.
Right? Yet, because we're made to feel guilty, like you got to be responsible, you got to fund these things. Then, create stability. I like as a midterm strategy, cash flow banking, cashflowbanking.com. It creates a place where you don't have those losses. You do have fees up front, so there are impacts of those fees. We're not going to discount that, but ultimately, you don't have a loss one year and go, oh, now I have that compounded loss factor. Nope, it can only go up as time goes on. And then figure out where you're going to invest and what kind of investor you're going to be. If you're not willing to do the work to figure out how to create cash flow investments that take and require your time, don't invest. This whole notion that a mutual fund's going to get you there, what were the returns in the 90s, Tim?
They were astronomical. We had 20%, 30%. I mean, it was the best run the market had seen in a long time.
Right. And what have been the returns of 2000 to 2010 or 2010 to 2020?
Total returns would be maybe 10% for total, right?
For that
that whole period of time. So if we're going to break it down by year, we're talking like 1% a year, maybe.
Right.
Right.
Okay. So,
2%.
but a lot of people are still quoting 10%, 8%. What the hell?
Yeah.
Why are they doing that? And how can they get away with saying it when it's not accurate?
Well, the market's always, anytime. So when I first started in finance, right, it was like sit down with your client, show them what's going to happen. And if you're going to show them a fund, you'd say, well, the fund over the last 10 years or 20 years has done 7% or 8%. But once again, I had the benefit of showing them the 90s, right? So I'm showing them the 90s. In 1984, so 401ks existed in 78 for the first time. In 84, the Congress passed a tax law that required participation guidelines. And so everyone started flooding the market. Everyone was in the 401k now. They had to be, right? So companies stopped offering pensions, 401ks, flooded the market with, and so in the law of supply and demand, right? All of a sudden, all this money is flooding the market and it's just elevated. So when I went back to show people last 20 years in this fund, I was showing 10% because that's what it had done. And so that's how.
And then saying a past performance is not an indicator of future results,
Exactly.
which is actually really true, but people still show past performance to project the future.
And even though we haven't been going anywhere near like 10% consistently for a while, I just saw a client send me the other day an illustration for a VUL that showed the market return.
And a VUL is a variable
universal
life. I like to call it very ugly life, but
Yes.
but you know, it's basically insurance costs combined with mutual fund costs.
Yeah, exactly. And so they were showing that their client, the person that drew that up for them, was showing them a 10% return over time to say, look how great this is going to be. But if you really go back and get the full history of the Dow, if we go back to when the Dow first existed, it averaged like maybe 8% before you brought in fees, before you brought in actual returns. When you go back in and calculate actual returns, you end up with about 5 instead of 8. When you bring in fees, you're going to drop that to like 4.
Oh,
So
my
you're
goodness.
keeping pace with inflation, basically. See, the thing is, this is so frustrating for the average investor, but this is because we've been trained to turn off our brain and just trust.
Yeah.
Do we think that Wall Street is worthy of our trust? Would you let Wall Street babysit your kids? No, you'd come like, oh, they lost a few toes. Bad day. You know, it's like, like you would never leave your kids with them, but you're going to leave your money there?
Don't worry, they'll bounce back.
Every movie that's ever been done about Wall Street is about absolute theft. We've got everything from the craziness of, you know, the fiber optics, so that we've got these supercomputers that are trading and skimming, right? Flash trading.
Yep.
We've got major institutions that when they make a decision, move the market, and the average investor doesn't know what's going on. We've got the restrictions of a mutual fund saying it's a growth mutual fund, so you're stating in growth even when it's not time to be in growth because of those limiting factors. Yes, we got people focused on lowering their fees with robo-advisors or index funds, and that's a step in the right direction. But the question is it a good thing to invest in the market? So the business you just bought or the business that your brother bought, what's the multiple on those businesses versus the multiple in the stock market?
Good question.
Well, astronomical, right? So the business that I just bought, we had to put a total of $320,000 in injection into the business. We'll clear, after the new bank note and everything, we'll clear about $500,000 in profit this year from that business. So, you know, better than 100%, right?
Right.
And we're hoping, fingers crossed, in a few days we'll find out whether we got a contract. If we get that contract, we actually just added 50% of revenue and profit to that company.
Now, any company in the Dow right now,
Mhm.
how much are you paying for the amount of return you're getting? You're paying $1 to get 5 to 8 cents.
Oh my.
So you understand? Like, this is the but nobody wants to actually do the work to acquire a business because they're afraid. They're being told it's too complicated.
Mm-hmm.
And therefore, they're saying set it and forget it. But if you set it and forget it in a mutual fund, forget having wealth.
Yeah.
You're not going to get wealthy. The mutual funds are going to get wealthy because they're making money on your money.
Mm-hmm.
You're taking the risk. They're getting the return. You're getting some return, but you don't know how much you're going to get. And these companies are highly overvalued because people are automatically putting money into their retirement accounts, whether the market's going up or down, whether it's worth it or not. And I just feel like that's an antiquated model. That's time has come due. It's time to invest in yourself. It's time to pay off loans. It's time to focus on cash flow. And it's time to figure out how can you increase your income and then be intelligent with how to keep more of what you make by saving on tax, saving on interest, saving on investment fees, and saving on insurance costs. It's going to get you a lot further ahead. It's not going to be requiring all this speculation. You're not going to be stuck in volatility. Because look, I was sitting in a book workshop with a bunch of people that invest and work in the stock market that were writing books. They were stressed. I was not. I didn't even know that the market was dropping because I don't deal with the market. I haven't had money in the stock market for so long. And the fact that you're buying this business is a brilliant idea. Look, at your brother was an employee for a Warren Buffett owned company.
Yes. Yep.
How did that company operate once Warren bought it?
Well, Warren's a great investor.
Yep.
Terrible manager. So what I noticed with that company was as soon as he bought it, what happened was value was extracted from both the customers and the employees.
Yep.
Right. And it made the company more profitable. So if you're an investor,
the stock went up.
Yeah. If you're an investor, you're
The
thinking,
lifestyle of
this is
employees
amazing.
went down.
But the morale went in the toilet at those companies, right? And at that company. And so then all of a sudden he's still making pretty good money. He felt like he was in a good position. They have this big meeting and he calls me and like, I don't think I'm going to be around in 3 or 5 years. With the changes they just made, they tell me not to worry.
Right? Can technology replace them?
The writing's on the wall.
Is there a way to get one employee to do the job of 2 or 3? Because that's all going to help the stockholder, which is the fiduciary responsibility of Warren and the investors.
Exactly.
Right? So then your brother does what?
So I said, well, you need to go back into entrepreneurship. Let's buy a business. Right?
Okay.
So he found a business and he actually said, if I can buy a business anywhere, I'm going to buy it wherever I want. So he picked the tropical location he wanted to be.
Hawaii.
In Hawaii.
Brilliant. Yeah.
So
you
he-
lived there for a while, didn't you?
Oh, I loved it.
So he bought a business in Hawaii. Total purchase price on the business was $500,000. He'll clear about $360 this year.
Think about that. Like, that's insane. And yet people aren't doing it. But I've been around hedge fund investors. I've been around, people that are trying to acquire. They're actually looking at what they would call an odd lot inside of private companies. Where can they find where the big boys don't want to pay attention because it's not enough shares? And where could they go buy something that's yet to go public or might not even go public, but is really profitable? And they're looking at, can they go with smaller amounts of money, which for them is, a few $1,000,000, and grab something that they know can be so much more profitable than the secondary market. So Amanda, we were talking about the secondary market. Mm-hmm. When you buy a mutual fund, you're buying something that the company has already raised the funds or had the exit that was the cash infusion for the company. And you're now buying from someone who, is just owning it because they own a mutual fund or they bought it. They didn't buy it directly from the company. They're just buying it on the stock exchange, which means it's only built by supply and demand. So how could Enron go from being a company that was valued heavily one day and $100 stock price to being $1 the next day? It's because people then had new perception to realize that they were fraudulent, and everybody sold it because they realized, oh, this isn't real. Mm-hmm. It was real until it wasn't, right? Yeah. It was perceived as valuable till it wasn't. And this is what happens. Mm-hmm. And so I think that we're in a dangerous territory with the stock market. And the reason it can have a 12% drop in a short period of time is because it's simply built upon the artificial demand of this is what investing is. Synonymous, just like Kleenex and tissue. Kleenex is the brand, tissue is the thing, but we call it Kleenex. We call investing the stock market.
Yes.
But there's other investments. And private and small businesses, like what I love is in a small business, it might have infrastructure, it might already have cash flow, but it might have an exhausted owner that took it from startup to that point that just needs out because they're tired. Yep. And if you could bring some ingenuity and innovation to that already existing business, you already have cash flow from day one. Startups are insane. Like when I think about venture capital funds and angel investors, how many of them swing and miss? And even a venture capitalist says, okay, if we make 10 investments, 7 are going to actually probably die completely and not do anything. 3 will be profitable. We'll kill 2 of them that are profitable because we're looking for the one that hits the major thing. But out of all startups, my guess is you got 999 out of 1,000 that fail.
Yeah.
Right? Because some of the startups aren't legitimate. It's just someone, tinkering and doing it as a hobby. But then you have a lot of things that it's a race to who gets there first. And there's no consideration for cash flow. And I'm getting really tired of the stock market with companies that are in massive negative cash flow, try to go public so that they can exit and make a bunch of money instead of use it as a way to raise capital to create something that's sustainable and really benefiting people. It's time for us to look at humanity and go, is this really what we want? Is this about giving value or is it about taking value? And that's why I don't invest in the stock market. I know I'm pretty harsh on this whole thing, but we look at volatility, we look at compounded cost, we look at all of these factors. And to me, the solution is invest in yourself. Gamble on yourself, not on someone else. Pay off your loans, build up liquidity, store your cash in a place that's protected and can get a few, 4 or 5%, which is better than a savings account. And you're going to be better off than losing and chasing and watching all this turmoil. And if you're in it where you can be a little bit active, because look, you're a full-time financial architect.
Yeah.
But you're buying a business.
Yep.
Just like Warren's out there buying businesses and all these type of people. Why wouldn't we look at that? Because smaller businesses don't have the infrastructure to create a multiple or create the attention from the big money. So there is an what I would call arbitrage opportunity there.
Yeah, absolutely.
Right? How would you explain arbitrage opportunity, by the way?
Arbitrage is what you just recognize there's already value that's not been captured.
Yep.
Right. And so you're going to go in and purchase it, create that value, and then you've gained the difference.
Yep. So look, we gave solution, we identified the problem. Any summary from you, Stolba?
I think for me, just on my end, we're not here to evoke fear. I think the conversation here is about solutions and helping paint a broader picture. We're just painting the stroke a little bit broader to help people understand that there's more options for them. There's more that they can do outside of the stock market, because I think all of us sitting around this table with all of the clients that we work with and the people that we know in our lives, and I think of the story from your dad from the coal mining and my family and your dad as a farmer, like we care about people and we want people to live their best life, and we want them to live it now, not in the future. And to be
now
able to
in the future.
Yeah, now and in the future.
Not wait for the future.
Yes.
Right.
Yeah. And just to be able to live your best life now and provide value to your family and your community in whatever form that you can. And when you feel stressed out and you feel fear around your money, it's not possible to really produce to the highest level that we're all capable of. And so that's why I wanted to have this conversation today. It's relevant. I think it's on people's minds. And I think we gave them some good solutions.
All right. So give up the story of you can't do it. Stop shirking responsibility or abdicating it, hoping someone's going to come in and save you. The stock market has failed people, including the most major corporations that we've ever known, and pensions have been decimated because of it, and yet we're still funding it. We're still doing this. Like, pay off your loans. Take care of yourself. Invest in your education beyond just higher education. There's people getting student loans for hundreds of thousands of dollars and no way to monetize that. You can get inexpensive courses online for $97 to learn how to market. You can get things like Build from Wealth Factory for $97 to learn about money and finance and increase your knowledge that way. You can text 44222 and put in the word wealthier in the subject line and get Killing Sacred Cows, because we killed a sacred cow today. But then we gave a little bit of solution. It's time for you to develop your own solution. What makes sense for who you are? If you can get clear about that, we even throw in What Would the Rockefellers Do, so you can learn where you can store your money until it's the right time to invest. Don't skip steps and try to invest in things that aren't right for you. Don't hope for the best and find out that it wasn't what it was purported to be, because we've exposed that for you. All right, this is Garrett Gunderson. Go to AskSomebodyNerds.com, ask your question. We'll bring answers, and love your life.